Good morning, this is Niels, head researcher at hypergrowthstock.com. So like I mentioned yesterday, we're providing a new product. It's called the Daily Market Report, and basically it's a video talking about some of the top headlines that are impacting financial markets. So this morning, Tuesday, February 2nd, the main headlines are what some are touting as the Battle of the Banks. The U.S. government versus U.S. financial institutions. And the latest round is with former Fed chairman and economic advisor to the president, Paul Volker. He'll be speaking in front of the Senate Banking Committee later this afternoon. And according to a recent article by Reuters, the main topic of discussion will be about limiting the bank's risks with customers' money. In particular, the talks could be around eliminating the proprietary desks of financial institutions. And now this has a lot of analysts worried and concerned about just the profits that banks can make if the proprietary desks are eliminated. According to a research report released by Morgan Stanley, institutions like Bank of America could lose up to 5% of their income if their proprietary departments are eliminated. Goldman Sachs, which relies heavily on proprietary trading, could lose as much as 10% of their income, and according to some, that's a modest estimate. So far, the earnings season has been fairly positive. Most of the banks have released their fourth quarter earnings. Goldman Sachs was the clear winner. They announced a profit of $8.20, which was higher than analyst expectations of about 5.20. Goldman Sachs also said they made $13 billion in 2009. A lot of this has to do with proprietary trading. JP Morgan Chase, they sort of second. They made $11 billion in 2009. Their earnings were better than expected, but comments from Jamie Dimon weren't as optimistic as what people were expecting. He didn't have a lot of positive things to say about 2010. Wells Fargo was also really good. They beat analyst expectations with a profit of 8 cents per share. Analysts were expecting a loss of 1 cent per share. Bank of America was probably the biggest loser. They released a loss of 60 cents per share, and that was higher than the estimated loss of 52 cents per share. So as we can see, the market, the Dow Jones Industrial Average, is trading in a fairly tight range. This morning we opened up at 10,186, and so far we've hit a high of 10,216. And right now we're just in modestly negative territory. Again, if markets don't like what Mr. Volker has to say, we could see another sharp sell-off, and at least give up the gains that we made yesterday. And now let's take a look at some of the banking stocks. So here we have J.P. Morgan Chase. As you can see, they have a lot of ground to make up. The January 21st was the start of the decline. Financial markets, financial institutions led the decline. And if we zoom in here, we can see that J.P. Morgan's trading in sort of a tight range today. They opened up at 153.65, and so far they've hit a high of 155.38. Another stock here, we can see same kind of chart. It's Bank of America. Again, January 21st was the start of the big decline, and if we zoom in here, they're pretty much trading just around their open. They hit a low of 15.31, and they hit a high of 15.52. So again, I think a lot of investors and traders are a little bit hesitant and wondering what Walker's going to say today. And JP Morgan, again, 21st, the decline. But we can see that they're doing a little bit better. They opened up at 39.70. They hit a high of 40.38, and it looks like so far this morning they're holding on to some of those gains. time will tell. And our last stock is Wells Fargo, and as we can see, they've been very, very volatile. They opened up at 28.93, hit a high of 29.08, and hit a low of 28.77. And as you can see, they're just sort of trading around their open. So that's really all for today. Stay tuned for tomorrow for more market headlines. Thank you very much.